So are you pouring your heart and soul into your e-commerce business, seeing sales come in, but you feel like your profits just aren't there? Are you sometimes confused by your bank's deposits and unsure if you're really making money? Or maybe the thought of taxes and legal stuff just makes your head spin. You're not alone. My name is Shakira, and I'm a CPA and the founder of Tapped Insider. In this video, we are diving into the critical mistakes that many e-commerce business owners make that secretly are costing them a ton of money. So let's get into it. The number one mistake is not establishing a proper business structure. Choosing the right legal and tax structure for your e-commerce venture is the foundational decision that impacts your liability, taxes, and overall business operations. Understanding how your business structure affects you if you get sued. Can they come after your personal assets? And what your tax filing responsibilities are is extremely important for your business compliance. If you don't know how you're taxed as a business, how are you supposed to know as the owner what to do? The main thing here is to note that if you're operating without an LLC, that exposes your personal assets to business liabilities. Now, sticking with a sole proprietorship when your profits are high, that could mean paying more in self-employment taxes than you would if you're an S Corp, where with an S Corp, you decide based on market rate what you want to pay yourself as a business owner, and the rest of it is moved to your personal return. So you're able to control the taxation with an S Corp. Not consulting a tax professional or a lawyer could lead to missing out on valuable tax planning strategies tailored specifically to your business. It's very important to start off your business with the right business structure. Now, mistake number 2 is underreporting sales. One of the most frequent errors we see is simply recording the net deposit that hits your bank as your total sales income. When you get a payout from Amazon or Shopify, that amount already had fees deducted, payment processing fees were deducted, maybe shipping costs and sales tax collected. That was already deducted. But most businesses sometimes just code the whole amount that they put in their bank simply as sales. What the bank, the third party, which is Amazon or anyone, their sales platform, what they deposit in their bank account is what they record as sales. The problem with that is the IRS gets reports from all these third parties also. And the amount that the third party reports to the IRS, they are reported before deductions. Okay, they send the amount of gross, but you're reporting it net after all deductions. This means if you reported your income after all deductions, you only reported what you had as sales, and you didn't break it down that this is sales, this is payment processing fee, these are these fees or that fee. IRS will likely be sending you a notice for underreporting your income, which potentially has penalties and interest associated, or even linked to an audit. That's because they're showing that you had more income than you're reporting. And not that you necessarily are underreporting your income, but you're showing them you're underreporting your income because you're only showing the amount that was net of all the deductions, which is less than what they received as what you sold. You have to make sure you're not underreporting your sales numbers. You have to report the total sales number and then break it down and deduct the expenses that came with it. Payment processing fees, shipping costs, and all those other things. Did I remember to tell you that we have a free tax and accounting proficiency community for e-commerce business owners just like you? Yes, we do. It's a school community and the link is below. We basically answer any questions that you may have in regards to your business and provide value and point you in the right direction so you know how to best handle some issues that you're having. All right, let's get back to the video. Mistake number 3 is incorrectly handling cost of goods sold. Cost of goods sold represents the direct cost associated with producing the goods you sell. For most e-commerce businesses, purchasing inventory is one of their biggest expenses. A significant mistake many e-commerce sellers make is expensing the entire cost of inventory when they purchase it, rather than when the goods are actually sold. So let's say if you buy $50,000 worth of inventory in January, but you have no sales, incorrectly, you're showing a loss of $50,000 for that month. That does not accurately reflect your true business performance because that expense didn't occur yet. You just have assets, which is the inventory you bought. That is an asset. It's not yet expensible because you haven't sold it yet. This incorrect accounting method severely distorts your monthly profit margins. You might have months with seemingly huge profits simply because you didn't account for the cost of goods sold in that period. This makes it incredibly difficult to understand your true profitability. It makes it difficult to make informed decisions about pricing. It makes it difficult to understand the effectiveness of your advertising spend and when to actually reorder inventory, right? Because you don't know when you're out, because you've already expensed everything. You wrote it all off in January and they're asking for your books. That's a problem. You're going to have to start explaining that. The correct way to handle cost of goods sold is to record your inventory as an asset on your balance sheet when you purchase it. The cost of goods should only be moved to your income statement as an expense as cost of goods sold in the period when the corresponding goods are actually sold. This way, even if you buy a large amount of stock in March with no sales, that cost sits in your inventory asset account and your margin for March is zero. Then in April, when you make sales, you match the cost of goods you sold in April to that revenue, giving you a clearer picture of your actual profit margin. Accurately tracking cost of goods sold also allows you to understand the profitability of each individual product. Now, I understand all businesses are at different stages, so tracking inventory may not be feasible for some. However, industry standard is definitely to have an inventory tracking system. Keep that in mind. That is very important. Mistake number 4. Not understanding landed costs. Landed cost is the total cost it takes to get your inventory from your supplier to your customer ready to be sold. It's more than just the price you pay your supplier. Landed costs can include various expenses, such as the purchase price of the goods, shipping and freight costs to get the inventory to you and your fulfillment center, custom duties and import taxes if you're importing goods, insurance costs during transit, inspection fees, warehouse receiving costs. A common and costly mistake is only considering the initial purchase price when calculating your cost of goods sold and setting your product price. You go ahead and set your product selling price without really capturing your full cost. Let's take, for example, maybe you did not ask if the inventory you're purchasing from China, from one of your manufacturers, will be delivered duty paid or duty unpaid, right? DDP or DDU. Then you get a shocking duty charge and you need to add that duty charge on top of your cost price to calculate your profits accurately. Now, if you find you are falling short, you then determine if you want to adjust for that deficiency by increasing your shipping fees or increasing your sales volume instantly by offering a buy more, get a certain percentage off, right? So that you could adjust for that on cost that you didn't realize. Put in that full cost before you go set your selling price and know what adjustments you need to make. When you underestimate the true cost of your goods by ignoring these additional landed costs, you end up with inaccurate profit margin calculations. This can lead you to underprice your products, thinking you're making a healthy profit when in reality, you might be barely breaking even or even losing money on each sale because you did not adjust your selling price accordingly. This mistake also affects your ability to accurately determine your marketing budget because you may be spending so much money on marketing, but truly your product is not even profitable. It's crucial to calculate and track landed costs. So this gives you a much clearer understanding of true profitability per item, like I said before, and helps you make informed decisions about pricing and promotions. Now we're going to be discussing mistake number 5, neglecting sales tax compliance. Sales tax is surprisingly complex and it's a critical area for e-commerce sellers. And the rules vary significantly from state to state, county to county, and is constantly changing. Here are some of the biggest sales tax mistakes e-commerce sellers make. Not understanding nexus. Nexus is the connection that creates a sales tax obligation. This includes physical nexus, like having a warehouse or employees in a state, and economic nexus, which is based on your sales volume or number of transactions in a state, even if you don't have a physical presence there. So you could get nexus from two ways, which is physical or economic. If you don't understand this and you're in e-commerce, that's a problem. Once you determine nexus, the next mistake is failing to register. Once you have nexus in a state, you must register with that state for sales tax before you start collecting it. Another mistake is not understanding how sales tax is collected on the platform that you're selling on. Every single platform, Amazon, Shopify, Etsy, they have a way they manage sales tax. Some of them will collect for you and remit it. Some of them won't. If it's your own personal website, you have to handle it yourself. If it's Amazon, most of the time they're collecting and doing all that for you, but you still have to file in your own state where you are nexus, in your own city where you live. You should never collect sales tax in a state where you're not registered, because that is illegal. You need to register before you collect. Another bad thing with sales tax is when people collect the money, but they don't send it to the state. That's a problem. You have to send it to the appropriate state, county, whatever authorities that you collected on behalf of. Now, misunderstanding product taxability varies by state. You need to know if what you're selling is taxable in your home state and in any other state that you're nexused in. Ignoring all these sales tax obligations can lead to penalties, interest charges, and even audits. Okay. Best thing to do is to automate sales tax collection, the reporting, and the remittance with tools like TaxJar, Taxify, Numeral HQ, or even Avatax, right? It is always good to consult with a sales tax expert who specializes in online sellers to ensure you are compliant. So there you have it. I have talked about the 5 critical mistakes that can seriously impact the profitability and overall performance of your e-commerce business. First one, not establishing a proper structure. At minimum, have an LLC to avoid exposing your personal assets to business liabilities. Second mistake is underreporting income. You must accurately record your gross sale income to avoid IRS notice for underreporting income. Mistake number 3 is incorrectly handling cost of goods sold. If you implement a system to track your inventory levels and the cost of goods sold accurately, this will be resolved, okay? When you don't understand your landed costs, it's a problem, right? That's mistake number 4. You need to track the landed cost for each product you sell to get a much clearer understanding of your true profitability per item. Mistake number 5 is neglecting sales tax compliance. You need to automate sales tax collections, reporting, and remittance with different tools. There are different good tools out there. Don't forget, we have a free tax and accounting proficiency community, and e-commerce owners just like you are in that community where we can help each other out. The link is in the description below. Like this video if you found this information helpful. Subscribe to our channel for more valuable e-commerce insights, and leave a comment below if you have any questions or other mistakes you've seen. Thank you for watching. Here's your more profitable and less stressful journey with your e-commerce business. Have a good one.